Welcome to the Go Beyond Disruption podcast. It's brought to you by the Association of International Certified Professional Accountants, the unified voice of the AICPA and CIMA. I'm Colette Charbaugh, and I'm part of the team in our Washington, D.C. office. Every week here on the podcast, you'll get insights from inside the accounting and finance profession that help you stay ahead of the curve, whatever business you're in. Over the last months, we've been reflecting our global community's focus on the coronavirus pandemic, and we've been doing that across the AICPA and CIMA's global touchpoints. In addition to creating dedicated online resource centers, which we've linked to in the show notes to this episode, we've used blogs, social media updates, podcasts, and live-streamed video webinars, including the one you're about to hear. It's an edited audio version of a video webcast from late May 2020, just a week ago, which explored how CFOs and finance organizations can build finance resiliency and return their business to scale. It featured AICPA and CIMA's Ash Noah in conversation with two guests, Kyle Hawk, a partner of corporate business functions at McKinsey & Company, and Matt Bradley, a senior vice president of product development for enterprise performance management at Oracle Corporation. Remember, if you need further guidance or resources, go to aicpa.org or cimaglobal.com and search from there for whatever you're looking for. And open this episode's show notes in your podcast app to find links to everything we've talked about. So, for episode 112 of the Go Beyond Disruption podcast, let's get to that conversation with Ash Noah, Kyle Hawk, and Matt Bradley.
Colette, thanks very much. The coronavirus has been devastating on individuals, on establishments, governments, and economies. Before the coronavirus hit, I'm sure you've heard the Canadian Prime Minister's famous quote from Davos. The pace of change has never been this fast, yet it will never be this slow. And how true is that as we face this crisis and as we are responding to it? The actual pace of change has become even faster. None of us have seen this level and magnitude of global disruption we are seeing today. And these are indeed defining times. Corona has hit the global economic system's reset button. But this reset also allows us and actually requires us to reimagine and to think of the unthinkable. So this webcast series builds upon the joint research of the Association and Oracle on agile finance. In this series, we want to be exploring, with insights from McKinsey & Co., how an agile finance function builds resilience. So it should provide us with some fuel and ignition to reimagine. Reimagine not just finance, but to rethink and reimagine how our enterprises will re-emerge from this crisis with new ways of serving the customer, new ways of delivering the customer experience, and getting your enterprises ready for what lies ahead as the new normal. In terms of the learning objectives from this webinar, I want to draw your attention to a few things we will be focusing on. So we want to set the scene and lay the foundation and the groundwork to discuss strategies that you as finance leaders can use to build resilience while you're dealing with uncertainty. It should enable you and to prepare your organizations to return your businesses back to scale very quickly. And it is really a critical time for you to be thinking about building finance capability. So you will be seeing some insights and some steps and pathways to build this agility and to build this capability. We also want to be talking about communicating the value and resilience story to both your internal and external stakeholders. So joining me today, I'm really pleased to welcome Kyle Hawk and Matt Bradley. Kyle is a partner of corporate business functions at McKinsey & Company. He is not a stranger to us. He's been a few webinars with us before. He leads McKinsey's North American zero-based productivity practice, and he works with clients across several industries and really addressing the efficiency and the effectiveness of their SG&A investments. And then we've got Matt Bradley, who is the Senior Vice President of Product Development for Enterprise Performance Management at Oracle. He is very experienced, globally experienced, and he has hands-on experience of running both small and large teams in product strategy and engineering. Please join me in welcoming them both, and I'll hand you over to Matt first to say a few words, then to Kyle, and we'll get into the webinar. Thank you, Matt, and thank you, Kyle.
Thanks, Ash, for that. Welcome, everybody. It's good to be here to chat with you today on these important topics and these challenging times. So hopefully I can bring some experience from our customers to bear and enlighten you and give you some guidance in terms of how we can move things forward.
Great, Matt. Good to be with you as well. My name is Kyle Hawk. As Ash mentioned, I'm a partner based in our Washington, D.C. office. In my roles that Ash described, I work with companies across industries and geographies to improve the efficiency and effectiveness of back office functions, drive sustainable productivity programs and resource reallocation efforts. And recently, like many of you, I've been spending a lot of time thinking about COVID response.
Kyle, thanks. Matt, thank you for joining us. So in the next slide, we'll see McKinsey's 5 Horizon framework. And Kyle, I would love for you to take us through this and just explain to us where on this horizon do most companies find themselves today?
Yeah, Ash, thanks. So let me start by saying that this is first and foremost a humanitarian crisis. And we believe there are 2 parts to this, and there's not a hard trade-off between the 2. One is around safeguarding our lives and the health of the public. And the second is around what we call safeguarding livelihoods, which is around jobs and the economy. So to your point, I'll spend a minute on the 5 R's and what they are. Resolve, this is around addressing the immediate challenges of the workforce, customers, and partners. Resilience is about addressing the near-term financial and operational challenges during the shutdown. Return is about creating a plan to return the business back to scale quickly post-shutdown. Reimagination is about defining how your institution will change in the, quote, new normal. And reform is about the wider industry shifts and how your industry or sector is going to change more broadly. And we hosted a virtual client roundtable last month and asked the question that you just asked me of where are companies at in this journey? And what we found is that virtually nobody is still in the resolve phase. About 40% are in that second phase or resilience, and about 50% felt like they are in the return phase. And so there are a few that consider themselves already in the reimagination phase, but many want to get there quickly because this is where you're going to define the company's path forward for the years ahead.
Thank you, Kyle. That is extremely helpful, and it gives us a grid. It gives us a framework of some of the phases. This is not like a quarter 1, quarter 2, 3, and 4 type approach, but these are moving bits. And as you said, various companies find themselves at various stages. So, Matt, I wanted to turn to you because you do meet with customers. You talk about their strategies to manage through this COVID crisis. Would be really interesting to hear the type of sentiment that you are hearing from your customer base at this point in time.
So thanks, Ash, for that. I think we'll carry on from where Kyle started in talking about the 5 R's and introduce 2 more. One is a certain level of relief that we're hearing from customers, relief that they've actually implemented cloud and have actually able to continue the work in moving up through the 5 R's that Kyle has mentioned in getting over those particular pieces by working, remotely leveraging our cloud-based services. The other one that we do see is a little bit of regret, and they're not far enough along. They haven't actually fully deployed everything that they'd want to, and they want to increase, especially around that scenario modeling or crisis planning that we've talked about. I think we've got a decent visual that we may want to have a look at that really describes, the differences between the two. We basically have got a scenario modeling capability inside of our cloud solution that has got some key elements. It's the ability to model changes in the business, but do it from an integrated financial statement perspective. So really looking across the P&L, the cash flow, and the balance sheet in totality. And obviously, there's been an awful lot more emphasis on both cash flow and balance sheet these days for organizations. So that's an important element. The other important piece that we see with inside of scenario planning is this notion of blending things together. So as we see a loosening in the restrictions both globally as well as regionally across the US, you have to understand what parts of the business will come back at what pace, and be able to blend several of those different ideas together is extremely important. But there are obviously some differences with inside of this crisis planning. The timeline is definitely a lot shorter. So rather than looking at it from a multi-year standpoint, we're seeing a lot of organizations work a lot tighter in terms of weeks and months in terms of that resilience and forward-looking reimagination that needs to occur. And we're also seeing it feed more directly into the more operational plans. So rather than it just becoming targets, it's really working in tandem with more detailed plans around reallocation of resources and replanning from that particular standpoint. So we are seeing, a couple of new things that are coming in through and a much more emphasis around this particular area specifically.
Thank you, Matt. And I know that there are several CFOs who actually struggled to close their books remotely because they did not have that capability to do remote closes, autonomous closes, etc. I want to move to Kyle again and talk about building this finance resiliency, how to return the business back to scale. The last economic shock and your research from then, you come across some key strategies for building this resiliency, Kyle. And the first being really bolstering productivity. Let me just zero in on that for a minute. Your research found that resilient companies that did invest aggressively in productivity improvements in response to the economic crisis, they actually substantially outperformed competitors in reducing both operating costs and coming out stronger. Would you tell us a little bit more about that research, Kyle?
Sure, Ash. So you mentioned our resilience research, so let me start there, and then I'll get to the point on productivity. So our research on resilience was done a few years ago, and it's not something new for this crisis. And what we set out to do a few years ago was to identify what companies did going into the last downturn and coming out in the last recovery. So from 2007 to 2011, what did these companies do to achieve and sustain a competitive advantage? And we looked at 1,500 public companies and separated the top quartile, or the top 25%, from the rest in terms of total returns to shareholders. And what I mean by that, total returns to shareholders, are just the stock price improvements plus the dividends paid out over the period. And so if you look at the resilient companies' position coming into the downturn, these companies did not have a starting point advantage. In other words, they were not biased towards a specific industry. They took certain actions during the 2007 to 2011 period that allowed them to gain and sustain their competitive advantage. So on the next slide, what we found is that there were 4 elements to the resilience playbook. First, they were able to sustain 30% more of their organic revenue growth through the cycle, and they did that largely by focusing on and protecting their growth engines by moving resources from the more exposed categories to those which had better outlooks. This is resource reallocation, and I'll come to that later today if it's helpful. The second is the point that you asked about, which is the fact that they were more proactive in driving productivity of their operating expenses. So the resilient companies, that top 25%, drove 3 times more improvement in their operating expenses as a percent of sales through that period. And in terms of inorganic moves, resilience had a higher annual volume of transactions, divesting more in the downturn and acquiring earlier in the recovery. And so on average, resilience did do about 40% more divestitures in the downturn and about 12% more acquisitions in the recovery. And lastly, the resilience cleaned up their balance sheet ahead of the downturn. So, for example, in the 2007 to 2009 period, resilience reduced their leverage ratio or their debt relative to equity. Well, the non-resilience actually had to increase it. And so you asked about productivity, so let me spend another minute there if it's okay. On the next page, you can see the results of, or one result from some research that we did in earlier this month, where we conducted a survey of about 100 CXOs and functional leaders across industries on their outlook in the months ahead on their SG&A or selling, general, and administrative expenses. And the first thing we learned was that cost management is in the top 3 priorities of the surveyed executives, regardless of their revenue outlook for the year. What you can see on this page here is another thing we learned, which is more than half of these leaders, 54%, have improvement programs underway to drive efficiency and effectiveness in their SG&A resources. And another quarter of the surveyed population have plans to start in the next 3 months or so. Yet the contrast to that, which was also interesting, is that 75% of all respondents felt, quote, somewhat unprepared or worse in their SG&A efforts. And so the bottom line, Ash, is that we see companies taking a page out of the resilience playbook, at least when it comes to this point on productivity.
Thank you, Kyle. So we can see how, in terms of the EBITDA and revenue outperformance, in terms of OPEX and productivity, also cleaning up the balance sheet, we can see how finance plays a key role in building that resilience. And Matt, from your perspective, you talked about regret and you talked about the capability to have remote closing, for example, access to information and data and reporting on the cloud. So as you are advising CFOs and you're advising CFOs to really focus on building this resiliency, could you talk about some of the capabilities that technology around cloud enterprise performance management software and EPM suite that can really help CFOs in times such as these? Sure.
The important thing underlying a lot of this is fundamentally data and access to data and making sure you've got the right data to the right person at the right time so they can make that informed decision. And with data, there's a couple of key things that we really want to highlight. One is obviously the accuracy of the data. And by accuracy of data, it really can be helped by having a single data model that spans the enterprise. So it's not looking at just the finance, but looking at both the front office as well as expanding on the back office to include HR. The better you can bring all of that data together, you can then optimize your processes because there's a common definition of an employee, a common definition of a product, et cetera, from that standpoint. So that really helps drive that accuracy of that particular data. The other thing that's important with data is obviously the timeliness. How up to date is that information, especially given the circumstances today. There's no longer a trend to really have a look at because things have dramatically shifted. So in order to really get the information timely, we're really talking about automation. How can you apply automation so you can reconcile the information cleanly and correctly? How you can actually move to what we would consider a touchless transaction moving all the way from the front end of the house, the order, all the way through to the generation of the invoice, and removing as much human interaction as you can so that it is true value add. That will free up resources to go do the more interesting things like the analyzing and the predicting and the forward-looking forecasting aspects. And then the third thing on the data is to be complete. And by complete, we're really encouraging finance to have a look at not just the financial information, but look at your operational information. Because your operational information may contain what we would consider leading indicators. So customer usage would be a great leading indicator, because finance numbers tend to lag a little bit. So you're really trying to get that early warning sign that something is either improving for you or not, you have to take corrective action. So that's where we'd want to bring in this operational data, both from inside the organization, but also from externally, from outside the organization. Customer sentiment would be an example, or, commodity pricing trends, et cetera, from external to the organization. But once you involve those volume of data, you really need to start to move towards machine learning so you can analyze that data at scale. The machines can spot patterns much more readily. They can cluster the information and then leverage that to do predictions. And that's where we're starting to see a lot more work being done, either via Monte Carlo simulation, so you can iterate through multiple possibilities, or even just good old-fashioned prediction, leveraging the machine to generate a forecast. And we're seeing a lot of companies start to move towards that fashion because you can now speed up that process much more readily and actually move forward much more faster from that standpoint. I mean, the screen that we have here is aspirational. We're not there yet, even as a product company, but we're starting to move towards this direction. If I take a couple of customer examples, if I take, say, ourselves, Oracle, we have the unfortunate financial calendar of our Q3 actually coincided, the end of Q3 coincided with the start of the lockdown in early March. And our finance team was basically told that if it takes us a little longer to close the books, we understand. But because we've invested and rolled this out, we actually did close a day ahead of schedule due to the remote access that we had in place. But we also see some smaller organizations also get advantages. If I looked at an organization like the Depository Trust and Clearing Company, they're an important organization in terms of managing a lot of the financial transactions in the markets today. They've done a full rollout of our EPM suite in order to close their books and also forecast and project things going forward. So it's just an example that it's not just for large organizations like an Oracle, but also some smaller organizations. And the last example will be, from a large bank in Australia. What they've done is basically put in place a process to look at all the activity of their close and put it into an active system so that when one activity finishes, it can immediately trigger off the start of another activity, introduce a level of automation, but also introduce this notion of performance improvement. So are we ahead of schedule where we were last year? Where are there roadblocks or bottlenecks in that process that we need to improve upon? And again, because it's all on cloud, when the lockdown occurred in Australia, they can continue to work remotely and continue to drive these things forward.
Thank you, Matt. So connected data, cloud EPM, and the ability to have forecasting on demand would be a real advantage in these times. So thank you for really articulating that and giving us an overview. So if we can switch gears from that capability and start to talk about the strengthening the balance sheet, and I'm going to go to Kyle for this. When CFOs are thinking about the next steps in terms of the strategy to reallocate resources and strengthen the balance sheet, what should CFOs be thinking about? How would you advise them, Kyle?
So, Ash, I would say when it comes to strengthening the balance sheet, there are a couple things one is, around divestitures and are there certain business units that no longer make sense in your portfolio and you can divest those and free up some capital that way. Another is around just pulling the traditional working capital levers to drive down inventory, extend accounts payables, bring down receivables, etc. I'm going to talk about strengthening the balance sheet from the perspective of making sure your resources, your capital allocations are going to the best place. And so there's lots of speculation about what the new normal is going to look like. And I think it's safe to say that each industry is going to experience some degree of change that is permanent in the recovery. And so one example is household goods, which we can all relate to and are familiar with as consumers. And in that industry, we're seeing a lot of consumers trade down to private label or simply switch brands because their old brand was not available. And while it varies by category, many of these consumers are satisfied with their new products. And so if these changes stick, it will require companies to reallocate their human and financial resources to different parts of the business. And so on the page here, what you can see is an example chart that brings resource reallocation to life in a finance professional's language. And so on the y-axis or the vertical axis, you effectively have forecasted return on investment. On the horizontal axis or x-axis, you can see the forecasted investment represented as the width of the bar. And then each bar is effectively an investment cell. And in this example, a cell is the intersection of category and geography. And that would be different and can be different across types of companies depending upon how you're organized. Regardless, we recommend that finance leaders create one of these for your own business and then have different versions of this chart for different scenarios that may unfold. And what you'll find is that your base case scenario, what you started the year expecting, will look very different from the other scenarios in terms of the height of the bars. And it'll prompt the discussion on how much to continue to invest in these cells and facilitate the dialogue with the leadership team of, should we pull back in certain areas? Should we invest more? Or should we stop investing completely? And when I say invest, I mean in the broadest sense of the term, including capital. And so on the next page, what you can see, and I want to bring to life, is that resource reallocation sounds easy, and creating the chart that I just showed probably is once you have the right data. But reality is it's really hard to make happen in practice. And this is because of human biases, primarily anchoring on the past. And we see a few practices which finance leaders can employ to enable resource reallocation, and I'll pick just two or three. One is around picking the right level of granularity in executive decision making. And we believe that the top investment team should be looking at 20 to 50 cells when making allocation decisions, where less than 20 is not enough, more than 50 is overwhelming. So 20 to 50 is kind of the key there. The next one is around employing techniques to break the biases, the human biases. And this could mean using a, quote, red team and blue team approach, where you give both teams the same question, but they're forced to argue different outcomes so that the leadership can see both sides of the story. And the final example is labeled Agile on the far right of the page. And this is the concept of creating an annual plan for only a portion, say 60% of the total costs, and then forcing the holdback of a certain part of the budget or the other 40%, so that you can decide how to allocate that on a quarterly basis throughout the year as needs change.
Thank you, Kyle. That's very helpful indeed. And as we spoke about, again, bringing in technology and the capability that comes with Cloud EPM, I just wanted to turn to Matt and see as to how customers might be leveraging the Cloud EPM capability to perform exercises such as what Kyle has just mentioned. Over to you, Matt.
Yeah, sure. So there are basically two sort of dominant technologies that we're seeing being leveraged today. And again, it really depends on which industry, which use cases are more prevalent than others. And so By way of example, we've been working in the retail area with some of the clothing manufacturers, and they obviously have got an interesting challenge in terms of, with the lack of traffic into malls and into retail stores in general, what do they do and how do they really manage that on a go-forward basis? What we've seen is that if they have, going back to our scenario planning that we mentioned before, because they had that in place for their traditional long-range planning, it's kind of like muscle memory. We can take that muscle and reuse it in terms of this short-term crisis-oriented style planning. So they're fundamentally looking at, when will traffic increase, where will it increase, in which particular products are more likely to be picked up earlier, and then do the blending that's required in order to really drive that forward. So it's this whole notion of financial flexibility leading to operational flexibility, which overall gets wrapped around this notion of strategic flexibility. We can shift the business on a dime because of these particular pieces. If we follow the retail example one step further, we're working with a couple of REITs that basically own and manage these facilities, and they have a unique challenge of which tenant will actually be able to pay rent on a go-forward basis. And ultimately, they need to be able to get the rent so they can actually maintain their mortgages and be able to not default, et cetera, from that standpoint. And they're having to make decisions as to which organizations will continue and move forward and which organizations can't. And some of them have had to pull back guidance, external guidance from Wall Street because of the crisis in terms of what that meant for them. And so they're leveraging, again, the strategic planning and modeling capabilities to really reset where things will be on a forward-looking basis, to get their handle around that. And then also to factor in additional expenses that they're having to bear, so that they can open up their malls and make them safe for consumers to come back into once restrictions have been lifted. So modeling things like how do we increase the density or reduce the density within food halls? How do we identify where there are congregation points as part of the flow and remove those? So looking at elevators and what's the right way to structure and organize traffic around those particular pieces, and doing limited investments to ensure that people have confidence to come back in through it. The other product that we see a lot of interest in is actually in our cost and profitability. So it's really helping organizations, to Kyle's point, to understand what really is driving the cost. Is it fixed? Is it variable? Is it direct? Is it indirect? And really focusing on the right things as you reallocate so you actually get the benefits you really need to see. And we see a lot of this, obviously, in the travel industry. We're working with some of the larger airline carriers really on what we would consider route profitability, which routes are profitable or which were profitable and which are not profitable. And then taking a forward projection of volumes of traffic to really understand which ones should be opened up first, what volumes they should be opened up with, and what is the impact from that particular standpoint. And then the last example I'll leave you with is in much more regulated industries like insurance, where state regulators impose, a certain threshold that premiums can be in place. And we're working with some of our firms in that arena to really help them understand, to a certain extent, refunds that have been expected because of the COVID crisis. We're not driving our car as much, and as a consequence, we have to give refunds back to organizations. And what's the right way to model those particular examples? And again, the ability of having a full allocation methodology, the ability to look at just the key elements that are important for the business, it's really speeding up that process so they can get back to business as normal, whatever that new normal tends to be.
So it really is around having that capability that turbocharges the ability to look at costs, look at margins, look at allocation, and decide what to dial up, what to dial down. And this significant reset in not just the economic activity, but also social activity is fundamentally challenging many of our assumptions. And so having this kind of capability that you talked about, Matt, I can see would turbocharge the capability of finance. And talking about turbocharging the capabilities around finance, Kyle, this is something very close to McKinsey's heart in terms of really recommending CFOs to turbocharge their FP&A capabilities. Would you speak to us about how does one go about doing that?
Yeah, Ashwin, it's probably a topic that's close to all of our hearts. And if I reflect on what I shared earlier on the resilience research, finance really needs to play a significant role in 3 out of 4, probably all 4 of those actions in that playbook. And then on top of that, consider the importance of what Matt's been talking about in terms of scenario planning in this uncertain environment. And what you're left with is this reality that now is the time for finance to lead. But finance must be equipped to lead in terms of their individual skills as well as their institutional capabilities. And what I mean by institutional capabilities are things like the systems and the processes that they have in place. And so we've been talking for years about this progression of finance, where on the far left, you're moving from being a transactional expert and frankly just efficient at processing journal entries, for example, to on the far right, becoming value managers to the business and truly being, the right hand to P&L owners and the CEO when they're making the most important strategic decisions for their business unit or for the company as a whole. And that evolution from transactional expert to value manager requires a combination of technical skills, soft skills, digital enablement, and a mindset shift of both the finance function as well as the organization more broadly. And so, that's easy to say, but harder to do. And so on the next page, I typically use this when I get the question of how do we measure progress on capabilities? It feels kind of soft and, hard to really say, are we moving the needle? And so one metric is to look at the impact that you're having on the organization and ask yourself, hey, are other functional and business line leaders coming to finance for guidance? Are you getting invited to weigh in on the most important strategic decisions, or are you stuck watching from the sidelines? The other metrics are more quantitative and therefore perhaps easier to truly, quote, measure. You could create or leverage an existing skills assessment matrix to see how each employee is doing on their progression on the dimensions which your organization deems most valuable. You could send employees through internal or external academies to build both the soft and the hard skills and tie promotion criteria to accomplishing these. And you could also look to set a percentage of how many finance promotions are done from within the department, because you would assume then that those people have gone through these capability building programs.
Thanks, Kyle. As a CFO, I understand exactly what you're talking about. When people get poached out of finance into the other functions, it really is an indicator of the partnering and the level of partnering that they are providing. You've really talked about the progression. We've all been on a journey from being scorekeepers to business partners, and now you're upping the game in terms of talking about value partnering. I wanted to highlight a resource that we have because building skills and building these combination of skills is very close to the association's heart. And what we have found that it is a combination of technical, business, people and leadership skills, and all of that with digital skills in the center of that, which really enables this transformation, creates this agility, and creates competencies to enable businesses to create resilience. So you talked about the skills. Also, what we are seeing through our research with Oracle as well, that it's a combination of technology and skill sets that creates this agility and resilience. So you've articulated skills and the type of skills and the development of skills and competencies that finance leaders should really be focusing on. But Matt, I want to turn it over to you and just talk about technology and how technology is a real enabler to turbocharge this role of partnering, this role of resilience that we're talking about in FP&A, and really make strategic finance professionals more effective.
Sure. Thanks, Ash, for that. I would echo a lot of what both Kyle and yourself are talking about. It is broader than just technology. In order to be agile within finance, you first and foremost have to understand the business that your company or organization is in. In that way, you can partner and work across the organizations. We generally see a similar progression, if I leverage off where Kyle was at, in terms of you have to start in finance first and be a beacon for the rest of the organization. We've optimized, we've streamlined, we've actually got our act together in terms of our processes. So looking at the close, how can we automate that close? How can we remove the mundane from that particular standpoint? To all intents and purposes, free up capacity for finance individuals to go do something a lot more interesting than posting journals, as pointed out by Kyle. So it starts there, and then really what we're seeing are trends in the organization to expand out beyond, to actually get forecasts and plans closer to the customer or closer to the individual who's working with the customer. And a lot of it is working in partnership with, say, sales, so sales can provide the forecast, or working with, inside of human resources, their strategic plans for the organization as a whole. As we establish a strategy, where do we want the organization to go? What are the skill sets we need for that organization? And making sure that human resources are putting together plans that enable that to occur. So we have got the right skill sets to deliver upon the strategy that's in place. So we see this much broader need to really push the bounds at both those particular levels. And it really is trying to empower the organization as a whole. From a technology standpoint, we are seeing, as we mentioned before earlier, an increase in machine learning, an increase in data analytics. And that's an area we expect to see the financial professional to improve a lot within, to really understand the nature of the data and to really be that partner, that analytical partner with the operational parts of the business to really drive that forward, to be involved in those conversations, to present the information in a meaningful way that they can absorb and actually bring in through. And that's a lot of what we see from some of the reporting capabilities that we're bringing into the solutions and services that we provide. So all of these are all key together in terms of really trying to address a much more advanced way of moving forward. We're all having to do more with less, so we got to automate the mundane. We're all trying to get access to the right information to make that informed decision, so we have to invest in those particular areas to bring those forward. But first and foremost, we got to really understand our business and make sure it's all driven from a business perspective.
That's fantastic, Matt. So as we think about the way forward, we've looked at these phases of McKinsey's 5-Horizon framework. Something that's really important, and as finance becomes a part of the story, a part of the strategy, it really is easier for finance not to just narrate the story, but in value partnering, you're actually co-creating the story. And when you co-create the value story, communicating that company's strategy, not just internally, but also to external stakeholders, is really, really important. Kyle, you have a few thoughts on that to share with us.
Yeah, happy to, Ash. And I think it is important to differentiate the two angles of, so let me first cover a few points on communicating internally with employees, and then I'll cover communicating externally, specifically with investors. So in terms of employee communications, I think a couple principles. First, give people what they need and when they need it. And so early on, this was probably about how to stay safe. Now it may be about how to stay mentally healthy. And in a few weeks, it'll be about how the company is going to change going forward. And so there are different communication approaches and messages at different points in time. The next one is around communicating clearly and frequently. And an example of a simple or clear communication are things that we're all familiar with, like do's and don'ts. And on frequency, remember that audiences have to hear a health-related message between 10 and 20 times before it sinks in. Third, on candor over charisma, you can build trust by being honest and frankly being vulnerable, especially when it's difficult. So don't sugarcoat things. Give people a view behind the scenes of, what the leadership team is thinking and working on. And finally, share your own personal experience around your family and your own feelings. Then there's a point around accentuating the positive to restore confidence. And you can, for example, share uplifting stories about how your employees are contributing to their communities and customers. And the last one, when I say establishing a mantra, this is a way to help people make sense of all the messages and all the chaos that they're hearing. And ideally, you can do this in a way that ties back to your organization's greater mission or purpose. And so across all of these, remember that communications are two ways. And so involve your audience, let them lead parts of the communication, and provide forums for employees to engage with each other. On the next page, I'll talk about communicating with investors. And our findings here are based on a panel of 10 long-term investors who we interviewed in mid-April. And the first point largely overlaps with what I just mentioned related to employee communications. Long-term investors are people too, and they care first and foremost about the health and safety of employees, customers, and communities. They also prefer, like employees, frequent and transparent communications. The next point on taking a through-cycle approach means that long-term investors want you to continue to pursue your most promising opportunities. They recognize that this may provide an opportunity, this crisis may provide an opportunity to move faster on some initiatives. And the investors in our panel focus heavily on R&D examples and also talked a lot about not losing critical talent and frankly seizing the opportunity to fill talent gaps, for example, when your competitors may be freezing their own hiring. And the third point is around near-term dividends and share repurchases. And Matt, I think, brought this up a little bit earlier. And these investors acknowledge that many companies don't have a choice, and they had to or will have to reduce dividends and repurchases. The next group of companies are those who are on the edge, where some scenarios present liquidity risk, but not all scenarios. And for these companies, the panel suggested to proceed with caution because you can act now, but don't make a decision that you're going to regret later. And of course, if you can afford to continue as planned on dividends and repurchases, then you should. And then in terms of guidance specifically, these investors prefer that companies provide guidance based on long-term performance indicators rather than short-term earnings per share. And this could be an opportunity to reset expectations completely around what your company does when it comes to short-term guidance.
Carl, thanks very much. That was extremely helpful. What we are hearing from you is clear communication, communication with transparency, communication with empathy, and really having also the capability to provide insights, longer-term insights to the stakeholders. When we think about these type of capabilities, I want to look to Matt and see if you have examples of how technology and some of your customers are proactively communicating with these stakeholders and actually deploying technology to do that.
Yeah, sure, Ash. We obviously our focus is really on financial results, given that's what enterprise performance management is. And But we have an example. We actually have deployed this internally within Oracle. We basically had two fundamental use cases that we were looking at. One is when we're closing our books, we are generating about 60 flux reports at the regional country level to really explain the numbers. And we also generate around 430 statutory reports for local filings. And both those were sort of, intensive operations that we basically try to solve with a new cloud solution around narrative reporting. It really tries to blend the nature of both numbers and text to really tell the story behind the numbers, rather than having individuals infer from, a P&L, a cash flow, et cetera, the current state of things. Part of the reason why our finance team was attracted to this arrived around a couple of things. One is we have direct connectivity to the data sources, so there's no cutting and pasting. There's no additional reconciliation that needs to be done. These are the right numbers, so we can save a lot of time and effort in preparing the numbers in the first place. Two, we also had this ability to establish a workflow across these important documents. And that was important for two things. One is the ongoing auditing of change. So we understand exactly this is the latest version, who's made changes to the particular document, why those changes have been made. So really collaborating around that sort of authoring and approval process. And the other piece was really respecting segregation of duties. Because these documents can be very sensitive, how do you make sure that the right people are seeing the right section of the document and we're not, having some leakage internally or even externally from that standpoint? So making sure we have some security around that particular piece. And then the most important thing that they have seen is that they do anticipate after the initial investment is having about a 80% savings for the next time they have to produce these reports. The ability to roll these forward, the ability to, leverage that investment in the next quarter, the next month, the next time they actually have to generate that particular piece. And so what we're seeing is obviously a dramatic improvement in terms of productivity, as has been a constant theme across the conversation today. Looking at how we automate some of this mundane work, making sure we don't lose any control, but also making sure we can bring in the right people at the right time to explain these numbers, to increase the transparency, as what Kyle is mentioning, to make sure that as we move external, these are the right numbers and it is the right commentary with the right tone and the right message in order to carry that forward. In terms of internal from Oracle, our next step is to move away from the actual side of the house and actually generate this as part and parcel of our budget variance analysis as we go forward. So as things fluctuate between the forecast and the plan, we can explain these to the appropriate stakeholders as to what's occurring internally. So it's an important key deliverable that we tend to see a lot more action within as we move forward.
Thanks, Matt. Automating the narrative is also helping finance to just have more capacity to really focus on the analytics. It's the same what we saw in production of report. Automating the production of report enables finance to really focus on the insights and actionable insights to help the business. So, how they can leverage technology and the examples you've given are really useful. Thanks for that, Matt. So I want to try and bring this to a close. A couple of final questions. I have seen myself as working from home, working remotely, some significant productivity gains. And things that are changing now, some of these we will see going back to normal. It's really easy today to actually get meetings with other colleagues because everybody is in one place, not traveling, not on planes, not in hotels, not in meetings, etc. Some of these things will go back to normal. But when you look at this, Kyle, we're seeing companies like Twitter saying that its workers can work remotely indefinitely. So would be great to get some of your thoughts on the trends that you're seeing and some of the trends that might actually become permanent.
Yeah, so, work from home is absolutely the hot topic and hot trend, both in the workplace as well as on the news. We've done some research on this, and to make this shift of working from home or working remotely, companies are going to have to overcome a couple challenges, and we just think about those challenges in terms of the people, the structure, the process, and the technology. And on people, look, there's going to be less daily direction and clarity, and that can lead to misunderstanding and be demoralizing for the workforce. So you have to watch out for that. I'll bring a couple of solutions to life in a minute. On structure, any previous lack of clarity around roles, decision rights, and governance is going to be amplified. On process, there's going to be some lower communications efficiency and greater difficulty in making decisions when people aren't staring each other in the eye in the boardroom or the conference room. And then on technology, there's going to be some new tools. And so, on people, I'll just focus on two. On people, it really is going to come down to, do you continue to maintain an inclusive and caring culture, empathy, like we talked about earlier, and are leaders ready to lead rather than micromanage from afar? And then on the organization structure, there's going to have to be some changes to design a simple, effective, and outcome-oriented structure where, this large team of 20 people may not make sense anymore, and you may want to think about breaking that down into smaller squads of, say, four groups of 5 or 5 groups of 4 who have some way to kind of come back together at the end of the day.
Fair point, Kyle. When I look at some of the things we are changing in the association, this crisis has given us permission to change some of the things that we've always done a certain way. Example is examinations. We have our CGMA exams, which were delivered in physical centers. So you had to go to an examination center to actually take the exam. And we have been talking about remote proctoring and delivering the exam to someone's home for a long time. But we never actually flicked the switch until this happened. And to think about a professional exam, a high-stake exam, to be taken sitting in your home was unthinkable, but we're actually doing that today. And so there are some of these changing mindsets that is happening as we progress along. So Matt, to close out, what are some of the trends that you are seeing that perhaps are accelerating because of these changing mindsets in finance? Would you talk about that to close?
Yeah, sure. I can give you a couple of thoughts on that. The crisis has a way of crystallizing people's thinking in terms of what is truly core versus what is context. And so we're seeing a resurgence in, enterprise performance management. We generally run counter to good times. In good times, nobody plans or forecasts, right? In bad times, it becomes extremely key and important. And the hope is that people will start to, embed that in and become much more realistic. That shift away from traditional brittle systems and doing an investment in a system and really driving that forward. So that's one trend that we are seeing a lot of interest in. And also with the core versus context, ultimately we are seeing a renewed interest or an accelerated interest in cloud in general. Can I get rid of my data centers and focus what my core business is and not be in the data center business and move that to a trusted partner from that standpoint. So we are anticipating, expecting to see an acceleration within organizations to move more and more to the cloud, to take this as an opportunity to do those investments, to level set and get an infrastructure in place that can then set you up for the next 5 or 10 years. So that's, I think, two of the big things that we are hopeful for, and we're seeing some early signs of as people come out and start on the recovery basis.
Thank you, Matt. I'd like to draw your attention to these resources that the association has provided. Please take advantage of them. Thanks very much again for joining us today. We'll see you soon.
Thanks for listening to this episode of Beyond Disruption, brought to you by the Association of International Certified Professional Accountants. Learn more about today's topic at AICPA-CIMA.com/disruption. This podcast is designed to provide illustrative information with respect to the subject matter covered and does not represent an official opinion or position of the Association of International Certified Professional Accountants or any of its subsidiaries or affiliates. It is provided with the understanding that the association, its affiliates, and subsidiaries are not engaged in rendering legal, accounting, or other professional services. If such advice or expert assistance is required, the services of a competent professional person should be sought. The association, its subsidiaries, and affiliates make no representations, warranties, or guarantees as to and assume no responsibility for the content or application of the material contained herein and expressly disclaim all liability for such damages arising out of the use of, reference to, or reliance on such material.